Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer, and I run the Cyclical Investors Club investing service over on Seeking Alpha. The link will be in the description if you're interested in joining over there. Align Technologies is the stock we're going to be analyzing today. This one came in by request down in the comment section of one of my other videos. If you have a request, just drop a note in the comments section. I'll put it on the whiteboard behind me here. And if it's a stock that's in the S&P 500, I post those on YouTube for free. And if it's not in the S&P 500, I post those over on Patreon and in the full Cyclical Investors Club service. Patreon's only $5 a month. And if you join there, you get a big discount if you ever decide to join the full Cyclical Investors Club. As always, this is not individual investing advice. This is just how I analyze stocks. So whenever I start to look at a stock in one of these videos or write about them, I always check any past coverage I've had of a stock because I've been doing this for a while now. So most stocks I've written something about, and Align is definitely one that I have, and I've even owned it before. So, and it has some pretty reasonable lessons, I think, that you can take away from it as well. I first bought this stock back in 2020. This public article is a hold rating, but I bought it during the March 2020 dip. I think I bought this one very close to the bottom of that dip. And it was one of the profiles of stocks that actually got cheap enough to buy during that very brief crash, because it doesn't, this is just my theory because I watch all these things. It wasn't a super large cap. It was kind of like a mid cap stock. It didn't have a lot of brand recognition by just normal investors. I don't think I'd even heard of it when I actually bought it. I was just mostly going on the metrics and profiles of things that I look at when I bought it. And it doesn't pay a dividend. And so it really didn't fit the category of stocks that have been popular around that time, especially with kind of retirees who are the people that have all the money. So I was very fortunate that the stock sold off more, and it was just a growth-oriented stock. So a lot of growth had been priced in. Whenever that growth, people think the growth is going to be interrupted, then usually the stocks like that sell off quite a bit. So I got a good opportunity there. And then I wrote about it publicly a couple months later. I wrote about all the stocks I bought in March because I bought like 20, 30. I think I bought 30 in March of 2020. I bought a lot. And then there were 20 of them that were in the S&P 500, including Align, and I wrote 20 articles in the spring and early summer of 2020 sharing all the S&P 500 stocks that I had bought. So I eventually, not only a few months later, I sold it because the valuation had changed so much in just a few months. If we look at the returns that I got, so I bought it on March 19th, so not the exact bottom. I think that's like 2 trading days or 3 trading days off the 23rd bottom. And I made 108% in 4 months. So unfortunately, I think this one was in my Roth account, so I didn't have to pay tax on it. So I took profits because the valuation had changed so dramatically, and really there wasn't a whole lot of light at the end of the tunnel in August of 2020 in terms of the pandemic and everything like that. So it just looked to me like when I did the math, it had gotten very expensive, and I write about that in these articles. So what happened after that is the stock doubled again, maybe more than doubled again. Let me see when I sold it. I'll take a look. So I sold it 7/30/20. We'll go to the fast graph, which would have been, what did I say, 7:30? Yeah, so let's say right there. And eventually, during the pandemic stimulus money boom, in 2021, when everybody took all their stimulus money and got their teeth straightened, there was a big spike in earnings. And yeah, so it rose another 150%, right? So if I was a perfect market timer, like people claim that I'm a market timer, you know, I could have gotten another 200% off my initial investment, right? I could have gotten 300 instead of 100. But when I was doing the math, it just didn't work out in terms of what they would have to do to justify that, because they grew earnings 114% this year. This is when everybody got excited. They priced it at a 75 PE, but because of the stimulus money was kind of a one-time or 2-year deal, once people had spent that, then earnings started coming down, and the stock price fell all the way down to here, 75%. So for a while, I looked really dumb because I just left so much money on the table. But when I do my projections, I project out like 10 years. So, you know, I had banked, you know, several years worth of potential growth, at least 5 years of growth if they grew at 20%, which I think is what I was using back then. So, yeah, if you could predict the market's irrationality and things like that, then you could maybe have gotten better. But for me, I have a process that I'm using. So I don't know. Let's see. What did I say? 7:30 was when I sold it. I don't know where it's at now. So right now, several years later, the stock is down 25% from where I sold it, so I don't look so dumb anymore. But now the question is, okay, we have earnings have come down, but now they look like they've kind of flattened out, and the bust part of the boom is over from the stimulus money, and so now we're into kind of a new normal situation, and we have to try to kind of assess what's going on here and what's a good price to pay, given that. So it has a 26 PE at today's PE, blended PE, or blended earnings. And the question is it, where should we buy now? And a lot of that depends on, now these guys don't have, well, they do have a history going back before the pandemic, but they were really a young company then compared to like what they were now. So I don't think we really know what a normal recession is going to do to their business, if they're still kind of in a secular growth mode where they could just kind of go through like a moderate recession. I think that's actually possible. And then we also don't really know what this post-pandemic growth rate is really going to end up being. Now, when I bought it, I was building in, I mean, I still paid a 25 PE for the stock. It's not like it was super cheap because I assumed earnings would grow at 20% for 10 years, which is pretty aggressive. Right now, I'm estimating 15% growth rate instead of 20. Right now, the market's kind of closer to 11-ish the next couple years, so I'm a little more optimistic actually than the market, at least with what analysts predict. I don't think anybody really knows where this is going to where this growth rate's going to kind of settle out at when it's all said and done. But what I do think is they're going to at least have, if we are in a recession and people have less money, they're going to spend less money to like have their teeth worked on generally. So especially the more like cosmetic type things. So that's kind of where we are now and where we've been. So let's just look at the math, and then I'll kind of take through like 3 different scenarios that I think we should consider. Okay, so I'm assuming a 15% earnings growth rate. I think that's optimistic but fair. We don't really know what's going to happen. But it used to be 20, so I'm being more conservative than I was the last time I bought it, but more aggressive than what analysts say that they think earnings are going to be the next couple years. So if we just use this, and we just use the straight up earnings expected this year, which we're almost to the end of the year, so I expect these will be somewhat close. This is basically fair value, maybe a slightly under fair, like 6.5% earnings growth CAGR over 10 years, using 15% earnings growth and $8 in earnings, which is a 26 PE. This would be like about fair value to maybe just slightly undervalued here if there's no recession in the near term. So I'm still kind of on recession watch. We're closer to a softer landing now, I think, than we were at the beginning of 2022 when we had a bunch of things. When Russia invaded Ukraine, we had student loans that could have come due. We had the stimulus bust with people running out of money. We had gas prices and energy prices going up, and we still had high inflation. And all those things put together, if they all hit at the same time, and no political cooperation to pass more stimulus, we could have had all those kind of hit at the same time, and that would have caused like a pretty good recession or bad recession, however you want to think about it. So I've been kind of on guard for that for the past like 2 years, basically. But we've kind of spread that pain out a little bit. Student loans just started to be repaid back. We did get like some stimulus. I mean, when you think of like, I don't know what they call it, like it was the chips, maybe it was the Inflation Reduction, whatever they call it. But we got government spending for like chips and some infrastructure and things like that. So we did get a little bit more types of stimulus, but not direct stimulus to individual people. So it kind of smoothed out the pain a little bit. And then also the interest rate hikes have taken longer to kind of get into the economy because people have fixed their loans out, people and businesses, for so long. So when you have these short-term interest rates go up, people can earn a lot more money if you're on their cash. So they get that cash to spend if you're like a retiree. But the borrowers are actually have not experienced that raise in interest rates fully yet, unless you're buying like a boat or an RV or a very expensive car that you need a car loan on, so, or a house, obviously. So we haven't quite fully felt all that yet, and that could be spread out a little bit longer too, just because of the way the fixed rates are in the U.S. It's not the same in other places like the UK and even Canada, I think. So there's a lot of that going on. But I do think the recession risk hasn't gone away just because rates are still high, and over time that's going to drag on things. Okay, with that in mind, I'm still in recession cautiousness mode. And so because of that, my buy price is still pretty low at 130, call it 136. Current price is 221, so it needs to fall about 38% to hit that price. If you don't think there's a recession coming, you feel like we're going to hit a soft landing, then this $174 buy price is where this would be like an 8% CAGR, and it would be worth taking a chance to get pretty good returns, assuming they can get something close to this earnings growth rate over time. Now, the interesting thing is I'm also watching the momentum on this. The momentum is still negative. It hasn't totally turned up. I like to see this be B- or higher. If we're trying to see if a stock that's fallen off a cliff like this has actually bottomed, but it's looking pretty much like this could be a double bottom here. So we'll see. I think that's up in the air still. But it's worth keeping an eye on. If I decide to kind of take a chance on it, I would want this momentum to be positive. So, but now what I think is interesting is I do have a lot of cash right now. And if we get into next year, which is only a month or two away, I mean, they won't report earnings until maybe probably end of January, beginning of February. So let's say we got 2 months. I don't know when their exact report date is, but their end of the year is in December. So it should come usually around that time. And then when we look forward, this is kind of the number that I would be looking at instead of this. And that would increase my buy price because I usually pull that year forward. So we're a little bit more conservative this time of year, as long as they hit earnings and this maybe goes up a little bit. So you can... What I'm trying to say is around February, the beginning of end of January, give or take, maybe the beginning of the year. If the outlook still looks good, this buy price could go up to 191. And then if I was looking at my cash levels and I was like, look, I have plenty of cash. I know this is a good business. Most stocks are more overvalued than it. I don't even know for sure if they'd be super hit hard in a recession. So when you put all those things together, this might be one you pay up for, is what I'm getting at, after the new year. And then, so if momentum turned up, if the price, was $190 a share, yeah, I mean, I might be able to take the chance around there. But that's up to each individual investor to kind of decide. I'm just kind of presenting the range of numbers that I would look at. And obviously, these aren't fair. Like right now, it's probably at fair value. So this is looking at buying at a discount because you want to get those bigger returns like I got in 2020. Now 2020 turned around super fast, incredibly fast. And I would usually a turnaround, like earnings turnaround and economic turnaround, is more like 3 years or something instead of, I don't know, 6 months or whatever it was the last time. So that's important to keep in mind. But I mean, I do think this is an interesting stock, a high quality business, and it's not trading like horribly overvalued. I mean, I wouldn't be selling it now if I owned it. If somebody bought, anywhere down here, no matter what happened, even if they bought a couple months ago and it was down a little bit, I would just keep on holding it. Okay, so that's my thoughts on Align Technology. I didn't go through the specific process of how I calculate everything in this video, but if you watch any of my other videos, you can see kind of what I'm doing with the recession PE and how I calculate this, which is just looking at how much earnings and earnings growth the business would make over the course of 10 years, given my assumptions. So that's the basics on how that all works. All right, if you have a request, drop it in the comment section. If you found this video useful, give it a like and subscribe, and I'll see everybody later.